We are expecting a Fed rate cut coming up this week on Wednesday. We are going to, in this video, look at some price history in terms of how the market has reacted to a Fed rate cut of 0.25% in a similar interest rate environment that we are currently in versus something like a 0.5% rate cut and how that affected the market here in the historical perspective of things. But before we get going, check out the Trade Cave store, link in the description as well as the channel bio. We've got some great products on there for you to browse. Also, smash that like button, subscribe if you've been with us for a while and haven't done so yet, and let's get into it. So first of all, the Fed rates currently at 5.25 to 5.5. There is now a coin flip between 0.25 and zero point 0.5. Basically, they're not even factoring in a continued pause at all. It's either going to be 0.25 or zero point 0.5, and it's a 50-50 right now as far as the CME watch tool is concerned. Now, let's go look at some price history versus some Fed rate cut history. We've done this before in relation to some specific tickers. You can go I'll reference that video here in the description as well as at the end of the video. If you want to go back and look at that, I did IWM, Bitcoin, gold, and the SPY in terms of how all of those reacted to Fed rate cuts in the past. Today, we're going to look specifically at the difference between 0.25 rate cuts and 0.5 rate cuts from a historical perspective. So let's go here. This is from Forbes, an article that goes over every rate cut since and increase, every rate decision basically since 1990. So we're going to start our journey at July 13th, 1990. Now, look here, the interest rate back then was 8%, so significantly higher than it is today. But we're going to look at how this journey began in July 1990 with a 0.25% rate cut, and then we're going to move from that. We're going to jump all the way back up to where we currently are, which is 5.5 percent rate cut, and they also did a negative. They also cut it by 0.25 when it was at that level in 1991 on August 6th. So that we're going to start in July and we're going to move to August 6th immediately after that and then work our way up through the years every time we had a 0.25 rate cut when the interest rate was anywhere between 5 and 5.5%. And then we're going to also look at negative 50 basis point, a 50 basis point cut on the SPX. So we're going to look specifically at the SPX on this. So this is market overall. So let's start here. One thing to pay attention to that I will note that I won't mention right now. The lines, so these horizontal lines, the white lines are a 0.25% rate cut. Okay, the yellow lines are going to be 0.5% rate cuts. So this is when rates right here, and now these are weekly candles, so it's not perfectly on the money there, but it's within a few days, right? Okay, so first of all, the first 0.25 rate cut that we're going to look at is in July 1990, and they did a 0.25 rate cut on an 8% interest rate. And look what happened immediately, just dumped, and just kept dumping. Now, I want you to look at this particular formation here and how it is, how it looks right here, like coming up, came down, came up again, did a little scoop, and went around. Okay, I have taken the this tool here, which is the bars pattern tool, and I have copied this and moved it to a different, more familiar time here on the current chart. And let's go look at that real quick because I want you to take a look at this particular cup and handle pattern down here, which I'll draw it real quick. There's a cup and handle like it came here, right? This cup and handle right here, woo, and then it kind of drifted off. Let's go back to the present real quick. Let's just go to the present real quick, and then we'll continue our journey here. But first, let's go back to the present. I've already moved it over there because I didn't want to do this twice. So let's go. There we go. Okay, so this is that bar pattern right here. This white line, these white bars. That's the bar pattern. Look how it has really lined up with. Now, of course, I did raise this up and stretch it out and stuff, but look at this thing. This is so similar. That July 1990 pattern is so similar to what we experienced in 2022. Now this happened a lot faster in 1990 than it did in 2022. Like each of these bars are still a week, and you can see each one of these bars covers something like 2 weeks or so. So it's like it took us twice as long in 2022 as it did in 1990. But just look at how uncanny that is in terms of its similarity. I think we went higher Yeah, and we went lower, I guess, on the cup and handle in 1990 than we did in 2022. But look at that. That is just so similar. Now, I'm not saying that's going to happen exactly. I just thought it was super interesting. I saw that pattern. I said, hey, that looks super duper familiar. So I went ahead and did the bar pattern over it. So if you want to do that yourself, that was the July. Now, of course, this is earlier than July. This is from like, the year before that. But the top of the brim here, the brim of the cup, if you will, uh, was July 1990, and then I took that all the way up until like 1993 or something. So that's pretty cool to look at. Now let's get back on our Fed rate cut journey. All right, here we go. So the next cut that we're going to look at that happened in August 6th, 1991, and that was when they cut 0.25% off of a rate that is very similar to what we are experiencing now. Okay, August 1991. That's the next cut. That's this one right here. Boom. August 1991, early August 1991, we went range. We range bound. We went range bound from August until November. So from August until November, August 1991 until November, right? Yep, until November 1991, and then we had a dip and then a rip. So by the end of December, so we started our cut in August. We had a range until December, and then in December we ripped. So Q4 we absolutely ripped. Now this would be a similar timeline to what we're seeing now. So of course we're in late September versus early August on this one, but I mean it was a ranging market. It ranged between, let's see, it went up words of 3% up and all the way down to about 4% down. So it was a 7% range that it was in. If we get a similar experience to 1991, which really wouldn't be too far off considering this where we are in this like cycle. We're pretty much coming up right into this space right here where that rate cut was in 1991 in terms of how our pattern currently is shaping out on the S&P 500 and where we currently are in terms of price and price action, and then where we will be in rate cuts. So that's pretty interesting. Then we had a 0.5% rate cut somewhere around here, I guess, which would have been what, December 91? December 91. Yeah, December 6th, 1991, we had, oh, that was another 0.25. No, December 20th, 1991, we had a 0.5% cut while the market was already launching. And look what happened. It just kept launching. Let's see. So we had a 0.5 while the market was moving up aggressively, and it just kept going until January, until late January, and it went up 5% before dropping back to the level that it was ranging in before the first rate cut. And it ranged after that 0.5% rate cut for a while. And then we had another 0.5% cut in July 1992. July 1992, and that was when rates were at 3.25%. They were just kind of, I guess, just slapping it down to 3 or under 3% July 2nd, 1992. So let's look at that. July 2nd, 1992. We went up a tiny bit, dropped for a while, and then started moving up. But we didn't start moving up until October. So from July until October, we didn't start moving up. Notice that we like to range while also kind of aiming a bit downward. So range with a bit of a grind down after a rate cut, and then sometime around a quarter or further away from the initial rate cut, we get a big move up. Notice it here with the 2.25% rate cut in August 1991. Notice it with the rate cut in July 1992. And I think this one was a bit of a fluke with that 0.5% rate cut in December 1991, because if you look before that, the market was on an absolute tear, and that just wasn't slowing it down. It took a month before that slowed it down and brought the market down from the pump. It went down 7% on a 7% correction after that, and then just stayed range bound for a while until the next year. For the whole year of 1992, it basically stayed range bound after that. Okay, let's move on to the next one. So we got a 0.25% rate cut here in July 1995. The rates were slightly higher than they are now. It was at 575. Right now it's at 55 to 525. So it was a little bit higher. So we'll look at the July and the December one for the 0.25 rate cut of that amount. So if you can see, going into that, the market was on an absolute tear from 1994 to 1995. I think we're going to see probably a similar sort of thing because we are also on a bit of a tear right now. And you see the rate cut came in July, and we went flat from July. It was early July until August. until the end of August, and then September we started taking off after that. So it was July and August, so 2 months of flatness after that 0.25 rate cut, and then boom, launch. And then we had another 0.25 rate cut, and this one was from 5.5, which is exactly where we are now. We had a 0.25 rate cut here. The market was still on a tear at the time, right? It was still on a tear. And then we got that rate cut. It went flat for 2 weeks. We had a drop. How big was that drop? It was a 3.5% drop. And then it was 6 weeks later, we were on a tear. And we just took off from January 1996, end of January 96 until mid-February. We were launching up, and then we range bound until May, and then went up again for the summer, and then dropped pretty hard late summer 1996. Boom, coming down there. Okay, so that's what happened there. Again, another rip up on a 0.25. 0.25 at 5.75 rip up, and that happened a couple of times with the 0.25. Aside from the only one it really didn't do a rip up after a short pause was July 13th, 1990. But remember, they were at 8% back then, not 5.75. When we were at 5.75 or 5.50, oops, or 5.50, and they did that 0.25 rate cut, things went up because I assume that showed that the Fed was calm and collected and not concerned about what was going on in the market, and figured that that was just a safe time to do it. All right, when is the next time we got a 0.25% rate cut when rates were at a similar time, or similar, sorry, level? Uh, it was September 1998. So let's go get ourselves over there now. So we went through 1995 and 96. Now we're in 1998. Okay, we had a 1.25% raise in 1997, and then in September 1998, we were at 5.25%, which is very, very similar to where we are now. We had a rate cut. Now we had, obviously, from July until September, which honestly is seasonal. July and August and September, terrible, terrible months. We were coming down, and we got a rate cut, a 0.25% rate cut after a drop, okay, after a market drop, and a rate cut from 5.5 by 0.25%. Now, this, as you can see, I don't even need to go over this. It's just ripped. It just absolutely tore up. Now, 1998 was part of the dot-com bubble, all right? This was getting near the end of the dot-com bubble. We are currently in what some would say is an AI bubble right now, and I don't think it's ready to pop. I think we're at a similar area to right now, and I bet you, and I haven't done this one yet, so let's do this one. This will be fun for all of us. Okay, we're going to start here January 98, and we're going to go into January 99. From January 98 to January 99. All right, now let's get this up here, make everything real small, and all right, squeeze that back a little bit, squeeze this in here a little bit. Now it doesn't look perfect, not really, but you can see we did the sell off. This time we went way up. We didn't come too far down. Maybe we could come down a little bit further. But anyways, we're looking on the cusp of a rate cut. So that rate cut was right around here, right here. So like right before where we are now. We had a big sell off right where we have right now. So came up, double bottom. Look what we're doing right now. Look what we're doing right now. Bottom, maybe a bottom here. It's an ugly one. It's a shifted one, but bottom. We also were coming up on it, right? Went flat in 98. Here we came down and then came up, went a little bit flat, and then went a little higher, and then made a bottom. We made another bottom here in first week of September, and then we came back with a vengeance here, and then it just took off from there. So if we get back above 56, 51, man, yeah, we could be going up, but not too bad. It did a bottom, took off. So this is in 98 was a bit deeper, and the double bottom was a lot more shallow than it is now. And this could look something like a double top too if we fail if we come below 51.42. But yeah, that's what we're looking at right now. So interesting. All right, where were we? We were at 98. All right, there we were. Yeah, and it just took off. All right, let's go move on to the next part of our story. So the next part of our story is a 0.5% rate cut. This one is in 2002. Now, I'm not going over 2001 because we all know what happened in 2001, right? So we got our first rate cut. We were at 6% in January 2021. Or sorry, 2001, not 2021, 2001. We got a 0.5% rate cut, and we dumped hard. And then in at 5.5, we had another 0.5% rate cut. We had 5.5% rate cuts back to back in 2001, and it just dropped. So, I mean, we can go look at January 2001 if you want. See, January 2001 was at the top of this hill up here, wasn't it? January 2001 was right here, and it fell. How far did it fall after those 0.5% rate cuts from 6%? It fell 44%. So if we get a 0.5% rate cut uh, starting now, yeah, I'm not too hopeful about that. That would to me would say that the Fed is panicking, and if the Fed is panicking, I would fully expect to see a pretty significant sell-off in the market. So I really don't want to see a 0.5% rate cut unless they really come through and say something about how that's really what they wanted to do. But I don't think it's what they wanted to do. We've seen in the past here that 0.25 is a even measured confident Fed, and a zero point 0.5 or higher is a freaking out Fed. All right. And then let's see. So what was this one? This one was November 4th, 2002. November 4th, 2002. All right. Oh, sorry, November 6th, 2002. They cut it by zero point 0.5, and the rate was only 1%. And look how much further it fell. Like it went up a tiny bit and then just dropped again. So those 0.5s, not so great. Zero point 0.5. Let me put another 0.5 up here. May, January. Boom, right there. It just sold off. And then this was near the end of the cutting cycle, right at 0.5, and sold off. So I really don't want to see a 0.5. Even at the bottom of that move, they did another 0.5 cut, and it just dropped even further. So I don't really want to see that. All right, let's go look. We're moving to 2007. We all know what happened in 2007, right? We had a rate cut in 2007. And let's see here, that rate cut, September 18th, 2007, we're at 4.75. So the Fed funds rate was actually lower than it is today, and they did a zero point 0.5 rate cut. And they did not do another zero point 0.5 rate cut afterwards. They started moving into 0.25s until 2008, where they did a 0.75. We see a 0.75. It's really time to get scared because something is broken, something is wrong. If they're doing anything other than a 0.25 increment, something is broken, something is wrong, and we're going to find out real fast in a bad way. Okay, that's my take on that. Anyways, September 18th, 2007, we went up for 2 weeks, and then it was just sell off from there. How far did we fall? Wow, did we fall possibly further than the dot-com bubble? How far did we fall? We went up for 2 weeks, and then we went down 57% off that 0.5 rate cut. All right, let's see. And then we had a 0.25 on October 31st, 2007. You know why they did that 0.5 in October, which was like, oh man, where even is it? It's like right here. They did that zero point 0.5 in October, same area, same level. They did that zero point 0.5 to try to make you feel like everything was fine, but you already did the 0.5, so you already released you already let the market know. They already let the market know that something wasn't right, and they just started dumping and dumping and dumping and dumping. I don't want to see a 0.5. That's super scary. And then there was another one down here, all the way near the bottom here in 2008, October 2008. Let's see, where is it? October 2008. There it is, October 8th, 2008, another zero point 0.5 cut when the rate was already 1.5. So October 8th, 2008, we had another cut, and that dropped the market another, how many percent? It went up for 2 weeks. Look, it wicked up for 2 weeks. How much did it wick up for 2 weeks? It wicked up by about 5% for 2 weeks, and then from there proceeded to drop another 33% before recovering. Okay, that's why I'm scared of the 0.25 next week, or zero point 0.5. Sorry, that's why I'm scared of the 0.5 next week. And I think that's pretty much all of them because we know what happened the next time. We had a 0.25 rate cut in 2019. Okay, but the rate was only 2. You want to see? Okay, we'll look at the one August 1st, 2019. August 1st, 2019. Where are you? August 1st, 2019. Where's it at? There it is. August 1st, 2019 was like right here. Okay, right here. This is a 0.25. Make it white. We had a little dip, and then we started tearing up until what happened in February and March 2020. So we don't need to go over that. But there was a 0.5 rate cut when rates were already 1.25 on March 3rd, 2020. A 0.5 rate cut, swiftly followed by a 100 basis point rate cut, which we had not seen since ever. Honestly, right? We had it in 2008. We had not seen it since 2008. Excuse me. the last time we had. If you get a 100 basis point cut from the Fed, that it is absolute pandemonium, and you should expect as much. The market's gonna absolutely dump. You better have cash on the sidelines to pick up that dip, right there, right? That big old dip. So that's it. That's the video. I got a little bit sidetracked here and there, but basically the 0.25 rate cuts generally led to either some sideways to upward action, whereas the zero point 0.5 cuts off of similar levels have been somewhat catastrophic in the past. Yes, there were severe underlying issues in the economy at the time, but I would argue that if we get a zero point 0.5 rate cut, that there is a severe underlying issue in the economy that we will soon be made aware of. I don't think that the Fed does anything but a 0.25 rate cut unless something is broken, unless they are scared. And if they go higher than a zero point 0.5 cut, then something is really so terribly bad we can't even comprehend it until they tell us it in the news. So until Wednesday, be on the lookout for a 0.25 cut. If we get a 0.25 cut, I bet you we could probably hit 6,000 on the SPY this year, on the XMP this year, 6,000. I would not be surprised because look how much high is that? If we get a zero point 0.2 cut, 60, it's only a 6% rise. We could do a 6% rise off of 0.25 cut easily. If we lose this area here though, if we lose like around this line right here, we lose 51.44 though, we're probably going to come all the way back down to like 45.32 on the SPY. Anyways, that's all I've got for you today. Please like, comment, subscribe, share this video if you found it informative or entertaining, and have a profitable day.